Right, we are now moving on from accounts receivable, and we are going to look at notes receivable. So when we have a notes receivable, it's because there's been a promissory note that's been created. And the promissory note is a written promise to pay a specified sum of money at a particular future date. So someone creates this promissory note, they're making a promise to pay somebody else back in the future. Promissory notes are more formal than accounts receivable, and they're actually a note is a legal document that you would prepare, and it would have all of the details and terms of the amount that's owed. Because it's more formal and it has this legal document, there's a stronger legal claim to assets if someone has this promissory note rather than just standard accounts receivable. As well, promissory notes almost always include an interest rate. So interest is charged and paid on the amount that's outstanding. So the document itself is called a promissory note, but in this case, we're looking at receivables. So it's just commonly referred to as a notes receivable. Just an easier way to just call it a note rather than saying promissory note every time. So notes receivable arise from mainly 3 different ways. So the first, and this is the most common, is when cash is lent or loaned. So we actually just lend money to somebody, so we give them cash and they make this promissory note, so we have a notes receivable. If a promissory note is created because money is being lent, the entry when that amount is lent out would be to debit the note receivable. It's an asset, so to set that up, we debit that. And because we're lending money, we would credit cash if this were the case. Cash is going out from our bank account, we've loaned it to somebody else. But a note receivable can also arise if there's a sale of goods or services and it just is done or settled by a note receivable rather than going into accounts receivable. So if the company decides they want to earn interest, maybe they require a note rather than AR. If this were the case, you would still debit note receivable because you have this note and you're going to receive it in the future. But now, since we're performing services or selling goods, our credit would either be to sales or service revenue. So we would be recognizing the revenue, and we're just setting up the receivable, but this time it's a note instead of accounts receivable. And then the third way that a note receivable could arise is on the settlement of accounts receivable. So what this means is that on the original sale of some sort of good or performance of a service, the customer just did that on account. So you booked a debit to accounts receivable, credit to the revenue. So that's what originally happened. And then when the AR actually became due, the customer didn't have the cash and they weren't able to pay. So they would talk to us as the business who did the work and has the receivable, and we would agree that rather than having them need to pay that AR right now, we would allow them to create this note, and that just says, okay, well now we've got the note instead, so it will have a different maturity date and we'll start charging interest on that. So if a customer can't pay the AR when it becomes due, we might trade that essentially for a notes receivable instead. So if this were the case, the journal entry at that time, again, we're still setting up the note receivable. So that's our new amount that we now need to collect. But here we would credit our accounts receivable account, because we want it out of accounts receivable and set up this note instead. So we're just kind of trading those 2 different types of receivables. Okay, so here's just a quick look at a really simple example of what a promissory note looks like. We've got the amount that it's for, the date that it was made. Here is the person who is the payee. So this is who's going to collect the money. So somebody is promising to pay this company. So they have the note receivable, this Foothills Trust Company. Again, just now in writing, we have the principal amount. This is the due date that is shown here. And then it also includes the interest amount that would be charged. And it's signed by the maker. So this is the person who's making the note and making the promise to pay. So Lauren Holland, it looks like, has said, I promise to pay $1,000 to Foothills Trust Company, and I will pay them on September 30th, including interest at 6%. So this one's really simple. An actual promissory note you might see in real life would have probably several pages that go through additional terms and all of the details of what happens if you don't make the payment and so on. So these are some terms that you need to know about promissory notes and notes receivable. The principal amount, that is the amount that you borrowed. So if someone borrowed $5,000 and had a note put in place, that is the principal amount. The maturity date is the due date. So that's when the final payment of the note will be made. Maturity value is the principal plus the interest amount, and it's the amount due at maturity. So notes receivable typically are not that long. Often they're a year or less. They could be more than a year, but typically they're a bit shorter term. So if that's the case, you often just pay the full principal and the maturity and the interest all at the maturity date. So that is the maturity value. The maker is also called the debtor, and this is the person who promises to pay. So they have that payable or the note payable. It's the liability side. So they are making a promise to pay in the future, and they're taking on debt. So that is where those names come from. And then the payee or the creditor, this is the person or the business who will receive the future payment. So they have the asset and they have the note receivable. So a way you can remember this, if you say pay or see payee, think about employee that ends with those two E's. So on the pay date, an employee is the one who's getting paid. They're collecting that cash. So same with the payee, they're the one who will receive or collect that cash in the future. So right now we are the payee because we're looking at notes receivable. Okay, now we need to know how we calculate interest on a note. So I said almost every note that you have will charge interest. And it's really important to note, as we, I think, talked about when we were discussing accruing interest in previous chapters, the interest rate on a note or any type of loan is always specified as an annual interest rate, unless it's noted otherwise. But pretty much all of the time it'll just say 5% interest or 7% interest. When it doesn't specify the period of time, it is an annual interest rate. So that means that the 5%, say, you would earn 5% if you had that for 1 year. Therefore, when we're calculating interest, we need to have, this factor of time, because our note, the maturity or the length of that note is likely not a year. So we have to use the factor of time when we're calculating interest. So we take the principal amount, the amount that was loaned, we times that by the interest rate, and this would be the annual interest rate most of the time. And then, as I said, you multiply by a factor of time. And time is based on whatever unit the term of the note is expressed in. So you might have a question that says the note is for 6 months, or it could say 90 days, or it could say 1 year. So whatever that actual time is expressed in, that's what we're going to use for this factor of time. So what I mean by that is if you're told the note is for a certain amount of days, when you're looking at this factor of time, you would take however many days, and divide that by 365, because that's how many days are in 1 year, and we're looking at annual interest rates. If the note is expressed in a number of months, you're now going to times however many months divided by 12. So however many months the note is outstanding divided by a total of 12 months, which is in 1 year for this annual interest rate. And if the note is expressed in years, you would just divide it by 1. So however many years divided by 1. Okay, so when it comes to looking at a note that is expressed in days, you have to be really careful and figure out how many days the amount is outstanding, and then you also need to know how many days are in each month. So that's what this funny little knuckle picture is all about. Hopefully you all know how many days are in each month, but this is just a trick if you don't. So if you hold your hands out in front of you, looking at it like this picture is, you can see that there's what I call up knuckles, and then these indentations between your fingers. So every time you have an up knuckle, this means that there's 31 days in those months. So the first knuckle here is January. It has 31 days. Then we've got a dip, which is February. So the dips equal 30 days, except for February, which either has 28 days or 29, depending on if it's a leap year or not. So you basically go through, count. So January, February, March, April, May, June, and so on. So this is a trick you can use if you need to figure out the amount of days in a month in order to calculate how many days of interest you need to record. Okay, so let's look at an example here. On January 1st, 2019, we lend someone $10,000 cash in exchange for a promissory note at 6% with a 12-month term. So first, we need to record this on January 1st. So that's the day we're actually lending the money. So when it says you lend someone, that means cash goes out. So on January 1st, we're going to debit the note receivable. Because we obtained this note, we have now this amount that someone's promising to pay us in the future. And we credit cash because we lent that amount. And the amount that was lent was $10,000. So we can say in our little explanation, lent money at 6% for 1 year. So we're just telling a little bit of detail about that promissory note. So if we look back, we know what the terms were. Okay, now on the maturity date, we collect the interest and the principal. What is the maturity date? What is the interest that is earned? And then what is the journal entry? So first, the maturity date. Well, if we look back to our question, we did this loan on January 1st, and it's a 12-month term. So if the note is stated in years or months, you take whatever this number date is, and it will be the same. It will just be however many months in the future. So in this case, it's a full 12 months or a full year. So it'll be the same day, January 1st, but now a year in the future, 2020. So say it was 2 months, you would still use the 1st, and you would say, well, 2 months in the future is February, March. So it would be March 1st, 2019. If it's in days, you actually have to figure out how many days in the future that maturity would be. Okay, so now it asks next, what is the interest that is earned? So remember, to calculate this, we take the principal amount, we times by the interest rate, and we times by that factor of time. So the 6% is in fact what we would earn in a year, and thankfully this time it is 12 months. So it really just works out. But that's not always the case. So our principal is $10,000, our interest rate is 6%, but we still want to do our factor of time. It's stated in months, so we would say 12 over 12. And if we do this math, we end up with $600. So that's our interest that we're going to earn over the term of the note. So now when we get to our maturity date on January 1st, 2020, we can record the entry. So we're collecting this amount. That means we're getting paid, so we'll debit cash. And since we're collecting the note, we need to get rid of the receivable that we set up when we originally booked it on January 1st. So we're also going to credit the note receivable. And at maturity, you always credit the note receivable for the same amount that you set it up as, because we never are putting anything to that other than the original principal amount. So we'll credit that for $10,000, but we're also earning this interest that we calculated. So to recognize that, we need to credit interest income or interest revenue, whichever is fine. And we calculated that as $600. Therefore, the total amount of cash that we're going to collect is $10,600. So our $10,000 note plus our $600 interest. Oops. And we would say here to record collection of note at maturity. Okay, so that is what a note receivable looks like. And that's just an easy example where we record everything at once. But we know from our chapter where we looked at adjusting entries that you actually need to accrue interest anytime you get to a period end and you're going to prepare financial statements. So in the next video, we'll look at accruing interest and the entries that go with that.